Welcome to this explainer. If you've been scanning the financial news lately, you know we're looking at a massive paradox right now. The world's largest economy is basically flashing two completely different signals at the exact same time, and it's leaving a lot of us scratching our heads. So it all boils down to this one pressing question that economists are debating behind closed doors. Is the U.S. economy quietly losing momentum? Are we just hitting a temporary bump in the road, or is the actual trajectory of 2025 fundamentally shifting?
Section 1. The economic paradox.
Let's unpack these mixed signals dominating the news. On the positive side, we've got a stock market that's just been roaring, unemployment is still sitting at historically low levels, and consumers, meaning you and me, are out there actively spending money. But then, there's the negative side. We have this stubbornly elevated inflation, and as a direct result, consumer confidence is noticeably sagging. It's literally like driving a car with one foot mashing the gas and the other hovering right over the brake skill.
Moving on to Section 2, GDP, the big picture.
To figure out where we're going, we kind of need to look at where we've just been. Through 2024, GDP actually expanded at a really healthy clip. We were totally defying the odds. But as we step into early 2025, the forecasts are definitely shifting and pointing toward a slowdown. Businesses are looking at policy changes and just a general atmosphere of uncertainty, and they're hitting pause. It's a real wait-and-see vibe out there right now.
Now, here's a crucial quote to keep in mind from the latest forecasts. Slower growth doesn't necessarily mean recession, but it can reduce hiring and investment. You hear the R word thrown around a lot in the news cycle to get clicks, right? But a slowdown isn't an automatic recession. In reality, it just means companies are tightening their belts, freezing new hires, and locking up their cash until the dust settles.
Section 3, the cost of living. So let's talk about the kitchen table stuff that actually hits your wallet. There are 3 everyday essentials keeping costs painfully elevated right now: groceries, insurance, and housing. Yes, overall inflation has dropped from its absolute peak a couple of years ago, but because of these 3 specific, unavoidable categories, it's still stuck above the Fed's target. You can't just opt out of eating or having a roof over your head, right? So these high costs force the Fed to keep interest rates high, which squeezes everyone.
And this leads to a really fascinating behavioral paradox. Consumer spending is still the absolute biggest driver of the U.S. economy. We're still buying stuff online, still going to the stores, but consumer confidence is weakening. When people are surveyed, they're reporting serious anxiety about those high prices we just talked about, plus worries about job security. Basically, we are still spending, but we're definitely sweating while we do it.
Which brings us to Section 4, the housing squeeze. If you follow real estate news at all, you know this frustrating domino effect. Step 1, we've got high mortgage rates combined with homes that are fundamentally super expensive. Step 2, that obviously leads to severely limited affordability. First-time buyers are just getting completely priced out. And because current owners refuse to give up their 3% pandemic-era mortgages to buy a new house at 7%, we hit Step 3, a drastically reduced number of homes for sale. The whole market is essentially stuck in a frozen loop.
All right, Section 5, jobs in volatile markets.
The labor market is a lot like the broader economy right now, sending totally mixed messages. Overall, the labor market remains incredibly resilient. We just aren't seeing the massive system-wide layoffs that some people predicted. However, if you look closely at specific hiring trends, they are absolutely slowing down in certain sectors. Tech is a great example. Lots of major players have quietly put strict hiring freezes in place. They might not be firing en masse, but they for sure aren't rushing to add new headcount either.
Meanwhile, Wall Street is trying to digest a wild, rapid-fire list of market volatility risks. We're talking tariffs that could disrupt global trade, heavily scrutinized corporate earnings reports, massive multi-billion-dollar AI investments that are still unproven, and entirely unpredictable geopolitical risks. Algorithms and human traders are trying to price all of this in every single day, which is exactly why the stock market has been giving us such whiplash lately.
Section 6, landing the economy.
So let's pull it all together. The U.S. economy is tough, no doubt about it. But looking at the 2025 headwinds, we've got 4 massive hurdles to clear to stay on track. Slower overall growth, reducing our momentum, persistent inflation, eating away at our purchasing power, incredibly expensive housing, locking up mobility, and finally, just a thick fog of general uncertainty making businesses hesitant to act. And it all comes down to 2 potential paths. Are we going to see a soft landing where the economy finally stabilizes, inflation cools off just enough, and we dodge a severe recession?
Or are we looking at slowing further, where that economic momentum continues to drop and those heavy headwinds finally drag the market down? The coming months are absolutely critical in determining which reality we actually get.
So, what will the coming months bring? We've unpacked the news, the data, and all these confusing mixed signals, but I want to leave you with this final thought to ponder. Based on what you are actually seeing in your own everyday life, at the grocery store, at your workplace, in your neighborhood, which direction do you think we're heading? Thanks so much for tuning into this explainer, and keep a close eye on the data.